Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. Real estate is made up by investors who make investments in properties or in debt. So, in today's market, it's a little difficult to raise debt. Not little, it's very hard to raise debt. But there are people out there who are looking to invest or who like the real estate market because they believe that in the worst of times, it's the best of times, as one of my guests would definitely say. So today I've assembled a group of individuals who are in the real estate business, who also raise money for real estate investments and operate. My guests include Ken Bernstein, who is the president and CEO of Acadia Realty Trust. Josh Zegan, the managing principal and co-founder of Madison Realty Capital. Richard Gorski, managing director at Ramius RCG. And last but not least, the ultimate optimist, my friend Norman Sterner, managing partner of Murray Hill Properties. Prior to the show, we were talking about how difficult it is to raise money from investors. And I want to preface for my audience, you're a publicly held company, you're a REIT, right, but also you raise money from pension funds and other endowments for right, certain transactions. You're a private capital company and you raise money from high net worth individuals and from insurance companies, pension funds, and investments. You're basically similar situation. And Norman, you're a real estate investment fund, who owns and buys buildings, and you normally raise most of your money from high net worth individuals.
Only
from high net individuals. So we're here in April of 2009. People say, hey, look, I know I lost money in the stock market. I don't know too many people who didn't last year, and they say, look, I'd like to own a piece of the apple. I mean, that's how you've got investors since 1971, Norman. This is 38 years. That's how all of your investors have been over there. You're saying to me that in today's market, these investors are a little skittish and schemish? They don't feel comfortable in the real estate marketplace?
I would say skittish is a good word. If not for the stock market, if not for the headlines, if not for the Bernie Madoff schemers, if not for all of those things, most of our clients have simply gone quiet.
So, today the NYU REIT event that Ken was speaking at, and I was there, I think one of the guys said, you want to leave money in the bank at 1%? Or what are these people who have made their money going to do with it?
I think the benefit of leaving the money in the bank at 1% is simply safety. I think you just have people heading for the exits right now. And I think that's, for instance, in our funds, which is locked up capital, I think, and we get a commitment and you get to draw it down over a period, I think people are re-examining how comfortable they are with that very long-term lockup where they can't get out, and also with the ability of the manager to draw down over time and the uncertainty of what those draws are going to look like.
I mean, how much have you raised in the last couple of years?
We've raised about $1 billion.
And right now you're sitting on how much would you say?
Between a mezzanine debt fund and an equity fund, we're sitting on about $500 million.
And most of these people are pension funds. You have some high net worth.
Largely in the most recent funds that we've done.
And what do they say to you? You know, they, like anyone else, read the newspaper or the press or the others. What do they say? What are they saying you should invest in?
They have just told us to be cognizant of what's going on in the world. They've been very supportive for the most part. I think they trust us. I think that was the reason that they invested with us initially. But I think they just don't want us to catch a falling knife.
Well, there's also what they're calling the denominator effect from you folks that are in the pension business. Between their denominator of their assets in the stock market going down and the denominator of the value of their properties going down.
Well, it's
It
the denominator
rebalances,
of
right?
not.
Right.
There's a perception in private real estate that values have held. We're on both sides. On public real estate, the values have dropped considerably.
That's correct.
So when they look at the amount of public equities they hold, and it has shrunk precipitously,
They have a problem.
versus the real estate that hasn't yet marked down, they think they're over-allocated to real estate.
Exactly.
That's going to work its way through over the next year or two.
Yeah.
But the opportunity and the bargain will be gone.
I don't think so.
Okay.
I think we're starting to see good opportunities now. But if you think back even just to the last cycle in the early 90s, pick whatever you think was the starting point. And you could say 91, 92, but there were several years where you could still acquire. So a lot of our investors, and very similarly, they invest with us, it's fully discretionary to Acadia, and they have no decision as to whether or not to send the money or not. But
Wait a second. I thought you said you had a $500 million fund.
right.
They have the discretion to send the money or not?
No,
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 he's
there
saying
is
it's fully-
absolutely no
Right,
discretion.
there's no discretion.
The feeling right now, in general, is we don't have a lot of visibility in terms of the economy. I think that will become clearer over the next year. We don't have a lot of visibility with respect to the debt markets. I'm also optimistic that that will be clearer over the next year. And there is still a likelihood that the big gap between the bid and the ask, or the big gap between where public REITs are trading, implied cap rates of 9, 10, 11, and 12, versus where sellers are willing to transact in the private, as all of that comes together, you will see increased transactions. I think you'll see some very exciting transactions. We're excited about it. I don't feel in any way as if we don't spend the money today, we'll miss the opportunities of a lifetime. But I agree with you, Norman. There are some great opportunities now, and many investors are sidelined.
Josh, you're out there raising money. What's the comment of the high net worth individuals that you've raised money from in the past, and from pension advisors and so on?
Yeah, the institutions don't know exactly where they stand in their own portfolios, so we're finding that if they're going to be anywhere right now, it's going to be on the debt side. High net worth are a little more lenient with their money, but at the same time, the big capital, obviously, in the business is on the institutional side, and I think in the next few months, some of that will open up a bit. At least from some of the pension funds and some of the endowments that will have some money to allocate.
Listen, I think from what I've been seeing recently, the debt side is more interesting, at least the high yield debt side, simply because you can earn equity type returns. And you've got subordination, you're in at a better level from a cap rate perspective. If you can earn 15 to 20% on the debt side, how much more upside really is there on the equity side? And I think that's been the disconnect.
So why don't they really look at, I mean, he's debt. You know, when he goes to investors, he's basically saying, you invest with me and I'm going to give you a return based on a debt. It's going
And
to
just
be
really senior secured debt.
secured first mortgages.
Right.
You're both equity and debt.
Correct.
But you're in your debt, most of it is mezz debt, which is a higher risk type of return. You're mostly equity, but you also have done debt. You're 100% equity. How do you look at the equity market today? Because people feel that, as I think maybe you said before, the falling knife.
Yeah.
We don't know what the values are really of the property.
Right. Well, at the simplest level, and one of the reasons that I agree with you that debt is very attractive today is it's one of the few areas that you can transact on as well.
Absolutely.
There's not a lot of high quality real estate. In our case, we focus on open air retail. It's not a lot of attractive deals to acquire today at realistic pricing. But on the debt side, you can buy the convertible preferreds of a host of highly regarded REITs that you'd be very comfortable with management and their ability to pay that debt off with maturities of 2 to 4 years, that the yield to maturity is 15%. So you're getting equity-like returns, and you're the senior most piece of the equity, if you want to view it that
Sure.
way, or junior debt.
Sure.
But that's immediately very attractive.
You know, Norman being in business, getting money from private investors over 38 years, would you say this is the hardest time you've seen in recent history
Well,
to get money from private investors?
if recent history starts in 1971
I didn't say
and goes
1971.
1981, well, go through it, 1987, and 1992, and 9/11, what we have found is that taking advantage of the hardest times for those that have that kind of risk in their portfolio, the rewards are just that much better when the market comes back, and the market always has come back in what we do. Mind you, our focus is so small. It's the island of Manhattan. It's from 34th to 60th. It's on an avenue, and it's a commercial office
Wait
building.
a second, you forgot Lower Manhattan is no longer...
Not for us.
I remember you used to own some property down there.
And we did, and I'm scared to death that folks like Larry Silverstein with subsidized, incredible properties can kill a competition. So, you know, we're just not buying downtown. It's just a wonderful place to invest when there's something else above 34th Street.
Wait a second, but I heard you say that you like 30th to 60th.
Right.
Now, I know that Ken he has a great shopping center that they took care of in Fordham Road, which is
in the Bronx.
In the Bronx, even with a good-looking Sears, which is like an oxymoron, you know, of having a Sears.
Well, they're a small part of it. They were the original anchor. They left early. In exchange, we put them in the concourse level.
So you don't like the Bronx?
Only to get to Yankee Stadium. You see, once I go back and forth from there, I'm lost
We're
for the
also
Bronx.
a different business. Ours is retail focused, which
exactly.
is a very different.
You don't have retail centers in Manhattan, you know, for the most part.
Right.
But you don't have a whole lot of, million-foot office buildings in the Bronx or in the boroughs. It's just, you know, thank goodness we're in different businesses. If we're all in the same business, we'd all be in trouble.
And I think that's an important point. I think everyone's in a business that they're very familiar with.
Mm-hmm.
On the office side, on the retail side, the first mortgage side. You know, our business runs the gamut across asset types, but with respect to the types of investments we make, high yield, higher leverage debt, and
high
equity.
yield, high risk?
Higher risk. Of late, I will tell you that the returns, in my opinion at least, the returns that are available on the mezz side, mezz is not what mezz used to be. We fortunately never got into the CDO game. And we left a lot of money on the table. And we had funds since 1999. When you had the CDOs going on, to me that was the real high risk mezz. What's being originated today, in large part, is filling a gap in the financing stack.
So I have a question. You know, we were talking about how does somebody, if they wanted to invest with you, and they were a qualified investor, which would be a certain dollar amount, I'm asking any of you, how would they get to invest? If somebody said, I'm really familiar with, they with you, that's rather easy.
Right. They
go
You
buy
can
our-
buy stock.
Go buy our
They
stock.
can buy your stock, or if it was the New York State teachers' retirement, they could get involved with you also
On our fourth fund or something.
on your fourth fund. And you are investors. How do they find out about you?
Well, we have an open-ended vehicle and a closed-end private equity vehicle, and we have an in-house group that works in investor relations and goes on the road and meets with pensions, endowments, consultants, fund of funds, family offices, and that's generally the investor base that we really target. And in our first fund, which was about $350 million, a significant portion came from pension funds and some of the investors that I said.
And what's the minimum? If somebody wanted to invest, is it $1 million? Is it $2 million? What's normally the number for a high net worth? Because you also have, I want you to answer first and then you.
Sure. $2.5 million is the minimum that we have. And obviously, case by case, we've taken different amounts.
$1 million. That makes them a qualified investor. We fill out the forms. Mind you, our investment book on Fund 4 is closed. What we're now looking for is the joint venture partner on the one-off properties that we buy.
Okay, so you're saying right now you're really gearing your deals to joint venture partners.
Always
like
have. We
as-
only invest up to 20% of what the fund's gross was in any single property, and the other 80% comes from the investment banking opportunity fund business.
Now, do they put the money in all up front, if the $1 million, or is it like you were saying about leverage with their subscription lines?
Right,
I think
Ken was
either
talking
one of
about
you
that.
were talking
Yep.
about that before.
No. It's 20% on signing, and the rest, when we call it, in tranches. We never keep people's money.
And what about you?
And it's a private equity structure whereby we generally have 3 to 4 years. Someone makes a commitment for $100. We have 3 to 4 years during which to draw down that commitment
Same
on
as
a
ours.
fully
Yeah.
discretionary
Same as
basis,
ours.
and it generally has a 10-year life. And I think that's, Josh, you had mentioned the open-ended fund, which I think is great. That's something that, from our perspective, we were never able to get comfortable with because of the asset that we're invested in.
Mhm.
We
I
just
agree.
think that, we didn't want people to have the ability to jump out in a market like this, for instance. And listen, we're all familiar. There's some deals, I can speak for myself, there's some deals that we have that are good deals, and there are some deals that we have that are not so good deals. The not so good deals, though, to the extent that the debt has term on it and it's covering debt service, there's no reason to jump out of that deal in this market.
So, Josh, since you're a little different, what do you mean by an open?
Sure, in an open-ended vehicle, we have a 2-year lockup on our money, and at that point, there's no actual pressure to liquidate a position in the event money wasn't available. At the same time, that business that we did was traditionally bridge lending, so a lot of times the loans were 1-year,
Right.
short-term duration kind of loans, and a lot of times there was a lot of churn in the portfolio, so that was appropriate for that kind of business. And when I say closed-end, which is our newer fund, a lot of that is going to be performing and non-performing loan purchases, and that's more appropriate for that kind of vehicle.
So my question is this, I'm not wearing my Dr. Evil hat now, but I do read new deals that have closed. 1540 Broadway, which 2 years ago was acquired for $1,067 a square foot, recently sold for $390 a foot. There are a number of office buildings. All you do is office buildings, so that's why I'm going to preface the question to you. Where do you see the office market in New York City? Because without an assumption of debt from a lender, it's rather difficult to do large deals.
If legacy financing is not available to be assigned, most buildings that require more than $100 million of financing, it's incapable of being purchased. And that's why nothing is moving. And everybody suffers from the brokers to the city not having recording fees, not having transfer taxes. But there is no movement. As far as 1540, it's really not a good example. It was a condominium. It had major vacancy. The retail was owned by Vornado. And one could ask, if they didn't buy the office,
Why didn't they?
I asked the same
No,
question.
so my big question is this. Forget the 1540 Broadway. There are other buildings for sale.
Not many.
Why? Because there's not money?
Unless it has an assignability to major financing and you're getting somewhere between 65 and 70%, it's hard to raise that. We have found we can get a mortgage in excess of $75 million from anybody, even trying to do a club deal. They just don't want to lend today.
You're seeing the same thing, Kim?
Fortunately, most of our assets are such that
It's
we don't...
smaller amounts.
Right. $50 million finances most of our single assets, so we have been able to finance. But I suspect as you go above that level, it would get very difficult.
Yeah, we're under contract that has a $450 million financing availability to be assigned to us on title. You can't replace that. It's irreplaceable. Onshore, offshore, Europe, it's irreplaceable. It's just too big. And that's what makes it attractive.
But I think that's a very important point, because what that shows, your willingness to move forward with that shows that you believe the world is going to come back. And I think that's what everyone has to realize, is that the world is going to come back. It's going to come back in a different form. Listen, 1,067 a foot, it should have, in my opinion, should have never gotten there.
Especially
should it be at $400 a foot?
Especially since it was an office condominium, there was no real upside. You didn't have the retail upside. You didn't have any great potential over there. So my question is, each one of you has a fiduciary responsibility, representing investors, pension funds. What do you do today? What do you look in the market? What do you want to do with your money that you're sitting with?
In our view, right, and one thing you certainly can do is sit. We can afford to be patient because the time period we have on our funds and our capital. But we can also afford to acquire if there's a realistic seller. Now, the harsh reality is we acquired about a month ago an asset that 2 years ago would have traded at about a 6% yield. It, at the time, had $9 million of NOI, would have traded for about $150 million. We acquired it for $78 million because it had lost one of its tenants, and the seller was very anxious to sell. So we were able to acquire it at about a 9% going in yield. Our borrowing cost will be between 6 and 7. That works. I'm not celebrating because it's still early in the process. We'll see how it all plays out.
But you know,
but that's something that works, because I can turn to our investors and say, here is a roadmap to making attractive mid-teens current yield on a leveraged basis on a high-quality asset.
And all you have to do is be patient.
Right. But if
Sounds
the
easy.
answer is forget 15%, all you can make is 6 or 7, then they'd rather go buy debt.
Yeah.
And so as long as you have the alternative to buy debt at low teens returns for a much shorter period of time, and then that money comes back and you have to go redeploy it, there's...
And it's also ordinary.
Right. So for taxable people, it's also different.
Yeah.
But while there is this dynamic going on, that's probably where pricing needs to be. And even at a 9% unleveraged yield for a high-quality retail asset, you're not going to have a lot of bidders, because most people are on the sidelines right now.
Yeah, and that's what's happening in stagnating New York. I mean, we're showing 9% sheltered by depreciation because it's the asset, and it's just not that easy finding a taker.
Just like the consumer has gone into hiding, and we're all in a state of shock to some degree, so is the investor, and justifiably so, considering what we have all gone through. But at some point, people are going to look at their 401k accounts, and if they're all sitting in cash, at some point, they're going to move off the sidelines, and they're going to look at shelter.
But you know, you bring out
I
a very
agree.
interesting point. Forget the individual. What happens to that pension fund who has a retirement obligation to fund the retirements?
Right. Well, the pension funds have not pulled out of real estate. Let's be clear about that.
No, but I'm saying they have an obligation that they have retirees coming in. They lost money in the market. Nobody really was protected from what happened in the market. How does that pension fund, you know, you're talking to those pension funds, what are they looking for?
Most of them are committed long-term to having a real estate allocation. It was never going to be 50%.
Right, I was going to say the real estate allocation that most of these pension funds had was 5%, 10% on the high end, so it was never a huge component. To what you said earlier, the stock market, the bottom dropped out, which was the liquidity within these pension funds.
The pension funds had equities. I mean, what are you saying?
Well, for the first time, some of them are exploring the debt side of the market. So some of them never did debt before, and that's like an education process. But when they are allocating, I mean, they're looking for mid kind of teen returns, and that's, you know, traditionally equity-like returns, but today you can get that on the debt side.
So they'll always be around. Now, here's the other side of the argument, and there is some legitimate reason to be concerned that some smaller pension funds, some less sophisticated endowments and foundations that played in real estate and private equity of the overall umbrella called alternative investments and got burned. Some of them may retreat for a long time. So there are a certain number of investors who existed a few years ago, and we may not see them back for a while. But in general, real estate is going to have a seat at the table. It is going to be an attractive alternative investment to the stock market. And I suspect once the world returns to some semblance of rationality, you'll see institutional capital come back.
And you think individual capital will come back to real estate that quick?
Yeah, first of all, on the pension side, they're constantly taking in new dollars. I mean, every day they're getting more contributions.
No, but I'm talking about the individuals. I'm saying you've raised a lot of money from individuals. Right now, you're saying they're sitting on the sidelines.
Right.
Do you see them getting a little, because when they're saying, as Richard said before, when they're getting 1% to 2% in the bank, you know, you want a little more return. You need a little more return for inflation.
For us, and as I said, we're in a very narrow market on who we get our money from and what we do. Most of them are entrepreneurs. Most of them are single, wealthy individuals. They're not going to sit with 0.25% in treasury bills for very long. We've seen the market come back now for 2 weeks. One of these times, the shorts are going to have to start covering, and then they will realize that equilibrium can return.
I think we got an idea of what people in the investment business, real estate business, and what the world is happening. I'd like to thank Ken Bernstein, Josh Zegan, Rich Gorski, and last but not least, Norman Sterner. See you next week.
Thank you much.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, The Moynihan Group.